Singaporeans, imagine this. You're sipping kopi at your favorite kopitiam and your phone buzzes, not from price alerts, but from dividends dropping into your bank account. No tenants, no million-dollar mortgage, just steady income. Today's showdown, requested by a viewer on our channel. STI ETF, also known as ES3, versus Amova REIT ETF, or CFA. Which one's better right now for cash flow-hungry Singapore investors? Stay till the end because I'll give you a simple, no-stress way to use both to build regular income. If this helps, like this video so more Singaporeans can see it, and subscribe to Wealth for You for easy, SG-focused dividend ideas. And just a quick disclaimer. This video is for education and entertainment, not financial advice. Always do your own research. Chapter 1. Dividend Investing Made Simple, Made Fun. Let's start with the heart of this video. Dividend investing. Dividend investing simply means buying assets that pay you cash, again and again, while you go about living your life. Imagine sitting at your favorite hawker center enjoying kopi, and ding. Your phone notifies you that dividends have just been credited. That's the beauty of passive income. Your money is working even while you're not. Here's how our two contenders make that happen. STI ETF or ES3. Think of this as a basket of Singapore blue chips. Banks like DBS, OCBC, UOB, big REITs like CICT and Ascendas, telcos like Singtel, and even industrial champions like ST Engineering. Twice a year, they share part of their profits with you in the form of dividends. Amova REIT ETF, also known as CFA. This one is like owning a slice of the best malls, offices, warehouses, and data centers across Asia ex-Japan. It bundles top REITs, Ascendas, CICT, Link REIT, Mapletree REITs, and passes their rental income to you every quarter. Both ETFs are what I like to call set and collect vehicles. You buy, you hold, and you collect cash flow. No late-night tenant calls, no property agent fees, no headaches. Just regular income flowing into your account, giving you the freedom to cover bills, reinvest, or treat yourself to that JB weekend getaway. Chapter 2. What they are and what's inside. Let's get to know our two contenders a little better. First up, the STI ETF, or ES3. Think of this as buying a slice of Singapore Inc. It tracks the Straits Times Index, which is made up of the 30 largest and most liquid companies on the SGX. At the top of the list, our three local banking giants, DBS, OCBC, and UOB, together making up nearly half the index. Then you've got household names like Singtel, ST Engineering, and of course the big REITs like Capitaland Integrated Commercial Trust, or CICT, and Ascendas REIT. Financials make up about 53% of the index. So when you buy STI ETF, you're basically riding on the profits of Singapore's powerful banking sector. Real estate adds another 16%, giving you exposure to malls, offices, and data centers you probably visit every week. And the best part? All this is delivered to you in one neat package with semi-annual dividends. No need to pick stocks one by one. Now let's talk about the Amova REIT ETF, or CFA. This ETF is like being a mini landlord across Asia, without needing millions for a condo or office tower. It tracks the FTSE EPRA Nareit Asia ex-Japan REITs 10% capped index, which simply means it owns some of the strongest and biggest REITs across the region, with no single REIT dominating too much. Singapore is still its home base, making up nearly 70% of the portfolio, but you also get exposure to Hong Kong's Link REIT, the city's retail giant, and India's embassy office, Parks REIT, tapping into the booming office market there. Inside the basket, you'll find familiar names like Mapletree Logistics Trust, Mapletree Industrial Trust, Keppel DC REIT, MPAC-T, Fraser's Centrepoint Trust, and even Suntec REIT with its iconic Suntec City complex. And here's a big plus for income investors. Unlike the STI ETFs' twice-a-year payouts, CFA distributes dividends quarterly. That means your portfolio pays you more frequently, almost like getting a bonus every 3 months. Chapter 3. Performance since inception. Let's talk about how these two have performed over time, because past performance may not guarantee the future, but it sure tells us how they've handled good times and bad. First, the STI ETF, or ES3. This is the seasoned veteran of the Singapore market. Launched back in 2002, it has been through SARS, the global financial crisis, COVID, and multiple Fed rate cycles. Despite all the ups and downs, it has delivered a long-term annualized return of around 17.4% as of July 2025. That's the kind of slow and steady compounding that has rewarded investors who simply stayed the course, reinvested dividends, and let time do the heavy lifting. Now let's look at the Amova REIT ETF, or CFA. This one is the younger sibling, launched in 2017. So it hasn't seen quite as many crises, but it has been through a pretty tough test. The 2022 to 2023 rising rate environment, when REITs globally took a hit. The good news? CFA has been bouncing back strongly. Year to date in 2025, it's up around 13.6%, and over the past year, it's gained about 5.5%, depending on whether you look at price or NAV. Because it has a shorter track record, we don't have a neat annualized figure like the STI ETF. But one thing is clear. CFA tends to move in cycles. It struggles when interest rates spike, but rebounds quickly when rates ease, rewarding investors who stayed invested and collected those quarterly payouts along the way. Chapter 4. Are they expensive now? All right, let's do a quick health check on valuations. Are these ETFs fairly priced today, or are we paying too much for them? Let's start with the STI ETF, which is trading at about $4.40 as of 12th September 2025. On a valuation basis, it's sitting at around 13.8 times earnings and 1.44 times book value. Those numbers are very close to the STI's long-run averages. In simple terms, this means the market isn't in bubble territory, but it's also not on a fire sale. Think of it like buying a solid, dependable HDB flat at market value. You know exactly what you're getting, and you're paying a fair price for quality. Now, switching over to the Amova REIT ETF, which closed at about 85 cents. Here's where things get a bit different. Metrics like price to earnings or price to book aren't as meaningful for REITs, because what really matters are things like cap rates, debt levels, and property valuations. Investors typically focus on whether the properties are well occupied, whether rental income is growing, and whether financing costs are under control. So in simple terms, the STI ETF is trading close to its historical norms, a steady, buy-and-hold candidate for investors who want broad exposure to Singapore blue chips. The CFA, on the other hand, should be looked at through the lens of property fundamentals and interest rate outlook, rather than just simple ratios. Chapter 5. Trailing and Forward Yields. Now let's talk about the part income investors care about the most, how much cash flow you actually get. Starting with the STI ETF, based on its closing price of about $4.40, the trailing yield comes in at roughly 4.1%. That means for every $10,000 you invest, you'd have collected about $410 in dividends over the past 12 months. Looking ahead, if payouts remain consistent, the forward yield is expected to stay in the 4 to 4.3% range, a nice steady income stream you can count on twice a year. Now over to the Amova REIT ETF. At its price of about 85 cents, the trailing 12-month yield is in the 5.3 to 5.6% range. So the same $10,000 invested here would have given you roughly $530 to $560 in cash over the last year. And with quarterly payouts, you'd be seeing money coming in every 3 months, almost like getting a mini bonus 4 times a year. If distributions hold steady, we're looking at a forward yield in the same 5.3 to 5.8% zone, which is pretty attractive for income-focused investors. Just remember, these numbers aren't set in stone. Yields move as prices move, and as new dividends are declared, so always check the latest data before you buy. Chapter 6. How a Fed rate cut likely impacts them. Now, let's talk about the big question on every investor's mind: interest rates. The U.S. Federal Reserve drives global borrowing costs, and when they cut rates, the ripple effects reach all the way to Singapore. For the STI ETF, remember it's very bank-heavy. DBS, OCBC, and UOB alone make up nearly half the index. When rates get cut, banks often see their net interest margins, which is basically the profit they make from lending, start to compress. That could mean slower dividend growth from the banking giants. But here's the silver lining: lower rates are generally good news for the rest of the economy. Companies get cheaper loans, property developers pay less interest, and overall market sentiment usually improves. So while banks might not earn as much per loan, the broader STI basket could still benefit from a stronger business environment. Now switch over to the Amova REIT ETF, or CFA, and this is where things get exciting for income investors. Rate cuts are typically a huge tailwind for REITs. Why? Because most REITs carry significant debt, and when borrowing costs fall, they keep more rental income for unit holders. Lower rates also make REIT yields look more attractive compared to bonds, which can push unit prices higher. On top of that, property valuations tend to get a lift as cap rates compress, which strengthens the REIT balance sheet and sometimes even allows for higher distributions down the road. So here's the bottom line. If the Fed starts a proper rate cut cycle, REITs like those in CFA are usually the bigger winners, both in terms of price recovery and potentially juicier payouts. If rates stay high for longer, the banks inside the STI ETF might hold up better since they still enjoy fatter lending margins. Chapter 7. Side by side. Let's lay the cards on the table and see what's good, and not so good, about each ETF. Starting with the STI ETF, also known as ES3. On the plus side, it's like owning a slice of Singapore Inc., a diversified basket of 30 blue-chip companies. The heavy bank weighting means you're backed by some of the most profitable and stable businesses in Singapore. And because banks benefit from higher interest rates, the STI ETF tends to be less sensitive to rate hikes compared to pure REIT portfolios. You also get semi-annual payouts that are relatively predictable, making it a dependable core holding. But it's not perfect. The yield is generally lower than what you get from REIT-focused investments. And here's the catch. If the Fed does start cutting rates, banks' net interest margins, or NIMs, could shrink, which means dividend growth may slow compared to what we've seen in recent years. Now let's look at the Amova REIT ETF, or CFA. This one shines when it comes to income generation. It offers a higher starting yield and pays you quarterly, which is perfect if you love the idea of regular cash flow. And because REITs usually rally when borrowing costs drop, CFA could see both unit price recovery and stable or even higher payouts if we do get a rate cut cycle. Plus, you're not just limited to Singapore. You get a nice mix of Hong Kong and India REITs, which adds some geographical diversification and exposure to growing markets. Of course, there are trade-offs here too. CFA is more rate sensitive. When interest rates rise or stay higher for longer, REIT prices can take a hit, and refinancing costs go up. You also need to watch for things like vacancy rates, rental reversions, and sector exposure. Retail and office REITs can face headwinds during economic slowdowns, while industrial and data center REITs tend to be more resilient. So it really comes down to what you value more. STI ETF equals stability and resilience, but a lower yield. CFA equals higher income and rate cut upside, but with more volatility and property market risk. Chapter 8. So, which should Singapore investors pick? Alright, here's the part you've been waiting for. Which one should you actually choose? If you're the kind of investor who values stability, wants broad exposure to Singapore's biggest companies, and prefers something you can set and forget, the STI ETF is your anchor. With around a 4% yield and lower volatility, it's the dependable workhorse that keeps your portfolio steady through market ups and downs. But if your priority is maximizing income, love the idea of quarterly payouts, and you believe that interest rates are heading lower, the Amova REIT ETF, or CFA, is the one that could give your passive income a nice boost. Its mid-5% yield and strong exposure to property assets mean you could enjoy both higher payouts and potential price gains when borrowing costs drop. And here's a simple strategy that many income investors love. Why not use both? Think of the STI ETF as your rice, the staple that keeps you full, and CFA as your side dishes that add flavor and spice. Together, they give you the best of both worlds. Banks and blue chips help when rates are high, and REITs shine when rates fall. That way, you're collecting dividends rain or shine, building a portfolio that pays you steadily and helps you stay truly cash flow rich, not just paper rich. Final thoughts. At the end of the day, whether you choose the STI ETF, the Amova REIT ETF, or a mix of both, the goal is the same. Turn your portfolio into a paycheck. Your investments should work for you, not just look good in your brokerage account. Being cash flow rich is far more powerful than simply being paper asset rich. Paper wealth might make you feel good when markets are up, but it doesn't pay your Kopi bill, your utilities, or fund that JB weekend trip. Regular dividends, on the other hand, give you real, tangible freedom, money that flows in even while you sleep. So keep it simple. Build a portfolio that pays you consistently, reinvest what you don't need so your income snowballs over time, and stay patient, and let compounding quietly do its magic. If this video helped you get clarity, smash that like button so more Singaporeans can learn this too. Subscribe to Wealth for You and drop a comment below. Are you Team STI Team REITs or Team both? Let's build a community of cash flow rich Singaporeans together, one dividend at a time.